Welcome back. You're tuned in to Bazaar Morning Call. Well, let's get to some fundamental stock analysis. We have Siddhartha Khemka, Motilal Oswal Financial Services, who joins us on the show. Hi, Sid. Good morning and good to see you. Well, IndusInd Bank will be the stock of the morning on the downside because, the street was like, okay, with regard to the extension of their top boss just a year or so. But just a day after that, you're announcing accounting discrepancies in Forex derivatives portfolio, which could have an adverse impact of around 2.3% on your net worth. The street's not going to like this at all. What's your view on the stock? Valuation has some support, and it's been a big underperformer. I think if you put in, a couple of percentage points down today, that would make it in the last 1 month or so. The stock would be down easily close to 17 to 18%. Your take?
Good morning, Nigel. Yes, I think IndusInd is the big one today. Very negative news flows back to back after yesterday's RBI's approval only for 1 year extension of the CEO, and now the discrepancy in the derivatives portfolio pertaining to transactions in the last 7 to 8 years, so FY24 and earlier, and we believe this could impact almost you can say 1580, 1600 crores of net worth. So what we have done is, we have downgraded the stock to neutral. We believe that this will not only impact the net worth, but also impact the growth in the coming quarters. With the board's focus on finding a new management, I think the entire energy would be driven there. And we are already seeing the Q4 being a weakest quarter in terms of the microfinance business. So I think it's definitely better to stay away from IndusInd for a few more quarters. I think whenever the announcement of the new management, that will instill some confidence to the market. Until then, I think the stock would remain subdued. Yes, stock has fallen down and valuations have come off, but with these kind of impact on financials, I think the valuation can take a further knock from here as well.
Hi, Siddharth. Today there is an upgrade coming in on Persistent where the target price is 40% higher than the current level. We're talking about CLSA upgrading Persistent to a high conviction outperform, and their target price is 9267. Now, Persistent, like all other IT companies, is corrected. It's down about 20-25% from its recent peak. In the IT pack, is there any stock that is attractive to you at these levels?
Yeah, good morning. So, if you look at the IT, I think they are reeling under the pressure of the US expected slowdown in the US economy, and that will continue for some time. Some of these stocks, which we like within the IT space, I think tier 2, the growth will be much better compared to tier 1, where the growth was about to recover. But again, with the talks of the US slowdown, I think the growth will be pushed back later. But if you look at tier 2, I think the tier 2 IT companies, the valuations were a bit high on back of the strong delivery. And two stocks particularly that we like is your Persistent, and the other one is Coforge, both of which we like, and we believe these are good levels to start accumulating. I think the pressure, especially in terms of sentiments, could remain weak for 1 or 2 more quarters until we see clarity in terms of the US tariff policy, the growth impact because of that. But I think the order books are pretty strong. Execution is pretty steady, and valuations look attractive given to the growth that they are liking. So we prefer Persistent and Coforge within the tier 2 IT pack.
Okay. Siddharth, hi. I just want to ask you a little about the chemical space because there's so much going on, a lot of different developments. Let me start with Thermax, first of all. Now that it's a chemicals company, but one of their subsidiaries is now, I think, going to build acrylic resins, getting into this tie-up with a Brazilian entity. What's your sense on Thermax, the core business, and then how do you view this development?
Yeah, I think yes. So if you look at the entire capital goods space, they have been under pressure because of the slower capex done by the government this year. And even if you look at Thermax, Q3 has been a challenging quarter with revenue up just about 8%, PAT declined 20%, impacted by the cost overruns and weak order inflow. So clearly, I think here the expectations for the coming quarters remains a bit muted. So we expect weak inflows, order inflows, as well as margins to remain under pressure. And even if you look forward for the next 2 years, the revenue CAGR is just about 12%, and with valuations such about 45-50 times, I think the stock could remain under pressure for some time. So we definitely don't have a positive view on Thermax in the current environment.
Okay, that's Thermax. Now let me talk about more core chemical companies. There's so much going on. Navin Fluorine, they're, I think, commissioning some additional capacity. Yesterday, we were speaking to Vinati Organics. And Vinati, for instance, explained how, despite the fact that 20% of their revenue is exposed to the US, they didn't seem too concerned. So within chemicals, what all do you like at this point? Because it's very, very complex now. Anyway, these are globally linked businesses, supply chains, end markets. And now globally, God knows what's happening with tariffs. Who's selling what to whom?
So definitely, I think it's a bit tough to call out the policy given the flip-flop by the US government. But nonetheless, I think one sub-segment of the chemicals, which is the fluorine-based chemicals, I think that is looking pretty strong because of the improvement in demand. Fluorine, the prices in US specifically has risen, and that is leading to strong outlook for the fluorine-based companies, SRF and Navin Fluorine. Between the two, in terms of valuation, we are much more comfortable in SRF, where they are showing strong improvement in growth in margins, plus the demand recovery. And we see sequential growth in Q4 as well as in FY26 in terms of the exports for fluorochemicals, as well as improved margins. So the outlook for SRF, we are expecting a 20% revenue and almost 50% PAT CAGR for the next 2 years on back of the improvement in margins. And hence, we believe that is the stock to focus on within the chemical space. We have a buy rating and a target price of 3,500.
Okay, all right. Sid, I was looking through a couple of notes and trying to look at sectors which will not be impacted by any capital expenditure slowdown here in India, Trump's tariffs, China. And one sector that came on my radar is the hospitals. And Apollo Hospitals, in fact, the stock has seen a fair bit of a correction from the recent peak. And the Motilal Oswal note itself is talking about the EPS going up by more than 50% in the next 2 years. They have expansion coming on stream that could be potential value unlocking as well. What's your view on Apollo Hospitals?
Yeah, so I think, Nigel, if you look at that's the space which definitely looks insulated from the global turmoil. And we have seen last few quarters, the healthcare space reporting strong numbers, both in terms of the occupancy, plus some of these hospitals have improved or increased the bed count, both greenfield as well as brownfield. In the brownfield, we see the margins improving much better. So I think occupancy has improved for Apollo Hospitals in the recent quarters, and the 50% of bed expansion will be commercialized in FY26 and the balance little bit on FY27. So strong growth coming out there. We see steady improvement in occupancy, bed capacity, as well as enhanced offering under the healthco business. And we are expecting almost 22% net profit CAGR going forward. And valuations also look comfortable. We have a positive view buy rating on Apollo Hospitals and a target price of 7,800.
Siddharth, the big development last week is that the European Commission has announced a major defense initiative, which means more spending, more capex. And the question is, will it benefit any of the Indian defense companies? We'll be chatting more about this with an expert too, but give us your initial take and what the Motilal Oswal research throws out.
Definitely, I think, Rima, if you look at the entire world is going towards increasing the defense spend, including India, where they have to take care of themselves. And that is a positive because there will definitely be a lot of new alliances, Indian companies which are looking for technology, which are looking to increase their export base out of India. I think that becomes a very key attractive point, given that India is a neutral country, both for the Western world as well as some of these Asia Pacific countries. And that bodes well. Some of the companies that we like within the defense space, BEL, HAL, Mazdon Dog, these are the preferred stocks. Even if you look at from a domestic standpoint, FY25, we saw a slower order book inflows for a lot of companies, which impacted the sentiments. But now the government is looking to meet its FY25 guidance, and over the next few days, we'll see a flurry of order going out, and that will improve the sentiment because that will give you the visibility. If you look at BEL, they've just secured a 843 crore order. So overall, the accumulated orders for FY25 now stood at 14,500 crores. We believe BEL will be a key beneficiary of the defense electronics opportunity across large platforms, be it Navy, Defense, Air Force. Valuations for some of them are attractive compared to some of the smaller names where the valuations have reached up 60, 70 times. So if you look at BEL, Mazdon, they trade in the range of 30-35 times PE with an earnings growth potential of 40 to 50% over the next few years.
BL is also in focus today on the back of order wins. As Upasana was earlier telling us, they've received orders worth 843 crores since 6th of March. With this, the total cumulative orders for FY25 stand about 14,500 crore, but it still falls short of the FY25 order inflow guidance of 25,000 crore rupees. So if they have to meet that, they need another 10,000 crore more.
Absolutely. Sid, I wanted to ask you about a couple of these insurance companies as well. Yesterday, the NCLT has approved the reverse merger of Shriram Life Insurance with Shriram Life Investment. This could be a positive read-through for Max Financial, because Max Life could get merged into Max Financial. There could obviously be appeals, but at least that NCLAT, green signal for the Shriram Group could be a positive read-through for Max Fin. Your take on the stock?
Yeah, I think the merger will definitely help through because it will improve the holding structure plus increase the cross-selling opportunities for the Shriram Group and eventually for Max. But if you look at within the insurance space, Max, I think they have been looking at a weaker set of numbers. Even Q3, the VNB margins declined 400 basis points, impacted by the higher ULIP share as well as the surrender charges. Even the shareholders' PAT dropped 54%. So I think the Axis Group merger, that should boost penetration. And despite that, I think the valuation looks a little bit on the higher side. Within the insurance space, I think some of the other ones, we recently upgraded HDFC Life from a neutral to buy. We see improved growth, margins seeing a good recovery. And for FY26, we see almost a 30% net profit growth for HDFC Life. The stock has been consolidating for a very long time, leading to a time correction in valuations, which we believe now looks attractive along with the improvement in growth. So within the insurance space, we would prefer an HDFC Life where we have a buy rating and a target price of 800.
Okay, all right. Thanks a lot, Sid. Always good to have a chat in the morning. Wishing you a good session ahead. It appears to be a bit of a tricky one, but we look forward to chatting up with you in the next few days.